Guys, we are extremely sorry for the interruption. So we will continue from where we left off. In this PDF, we are looking at question number in our illustrations. In your addition to study material, we were looking at question number 62 now. 61 we have done. Yes, it was 2,15,000 or 25,000. ABC Limited manufactures control units for its air conditioning systems. Each control unit requires the following one component X at a cost of 1,205 and one component Y at 800 rupees. Sundry raw materials at a cost of 150 rupees each. The company faces monthly expenses, which is rent of 16,500, energy cost of 7,500, selling and distribution cost of 10,000 rupees. Each unit takes 2 hours to assemble, and production workers were paid 300 rupees per hour. 2 hours to assemble, therefore 600 rupees. The production overheads are absorbed into the units using the hourly rate. The normal level of production per month is 1000 hours. Determine what is the cost of inventory. So I would rather look at the solution rather than solving it. Look at what is the air conditioning requiring X component of 1205, which is the first thing, Y component of 800. These are the two things. Sundry material of 150. Labor 2 hours of 300 rupees per hour makes it 600. Factory rent should not be considered. Selling and administrative expenses should not be considered. Energy cost definitely should be considered as a production overhead, which is absorbed based on their normal level of production. That is given in hours as 1000 hours. Therefore, 7,500 rupees of energy cost divided by 1000 hours is the total production overheads absorbed at 7.5 rupees per hour. Like this, each unit takes 2 hours to assemble. That means the total cost expected to be included is 15 rupees. So, he has included even the rent also. That's actually the storage cost, but he has considered it as a factor rent to be included. So, I'll solve it. Just check. We are looking at question number 62. I am trying to determine my fixed overheads absorption rate. Fixed overhead absorption rate. My fixed overheads absorption rate should particularly exclude selling and administration overheads, which is already given in the question. I am excluding it. He has considered factory overheads as not a storage cost. He is considering it as a factory overhead, fixed overheads itself. So therefore, what is the cost? Factory overhead cost is how much? Look at the factory overhead cost. It is 16,500 and 7,500 rupees of energy cost. So therefore, I'll write it like this. 16,500 plus 7,500 divided by 1000 hours. That will give me rupees. How much it will be? 23 per hour or 24 per hour. It will be 24 per hour. If I want to calculate the total cost of air conditioner AC, I'll have to go like this. First, my inclusion should be with respect to product X, second with product Y, third one with other sundry material, fourth with the additional labor cost, fifth with production overheads. Looking at question number, the product X. If I look at the cost of the production, look at the values. It is 1205, 800, 150, 300 rupees per hour. So, taking up the addition, 1205, 100, 150. Labor is 300 rupees into 2 hours, makes it 600. Production overhead 24 multiplied by 2 hours, 48. And the total cost of production of one air conditioner would be 1205 plus 800 plus 150 plus 600 plus 48. Makes it 2803. Makes it 2803. Selling and administration cost should not be considered as a cost of inventory at all. So you can leave that out there. Answer is 2803. Absolutely correct. Look at the next question. Question number 23. A dealer has purchased 1,000 cars costing 2,80,000 on a deferred payment basis. Guys, this particular deferred payment basis, when I had this paragraph discussed under IND AS 16 itself, I told you it is common for IND AS 16, 38, 40 and also IND AS 2. So it is 25,000 rupees per month per car to be paid in 12 installments. Guys, it is actually 2,50,000. But how much are you paying? 25,000 rupees per month. I am paying in 12 equal installments. That means in total I am paying 3 lakh rupees. At the year end on 31st March, 20 cars are in stock. What would be the cost of the goods, the finance charges and the inventory carrying amount? Guys, inventory of cars should always be valued at 2,80,000 rupee only. So therefore 2,80,000 rupee per car. If I have in my inventory 20 cars, then 2,80,000 into 20, 56 lakhs should be considered as the value of inventory. However, each cost or each vehicle is sold by the dealer or is purchased on a deferred payment basis at 25,000 rupees per month. That means the actual value which you are paying for the car is 3 lakhs. What is the cost? 2,80,000. So 3 lakh minus 2,80,000, finance charges are 20,000 rupee per car. 1,000 cars, 20,000 rupee per car. So basically you are looking at 20 lakh rupee of your interest or commission charges or finance cost. The inventory should be carried at the same amount, that is 56 lakhs. The total value of the car is 1,000 cars into 2,80,000. 1,000 cars into 2,80,000 is nothing but 28 crores. Yeah, 20 cars into 28 lakhs is 56 lakhs. Finance cost is 2 crores, 20,000 rupees into 1,000 cars. Cost of goods sold, 980 cars sold at 2,80,000 is 27 crore 44 lakhs. Is only using the concept of interest in that. Only absorbing the concept of interest in that. Look at question number 64 then. ABC manufactures and sells paper envelopes. Cost of each envelope which included in the carrying closing inventory is at a cost of 50 rupees per pack on 31st March 2021. During final audit, the auditor noted that the subsequent selling price of inventory on 15th April was only 40 rupees per pack. It was only 40 rupees per pack. Further, inquiry reveals that in the during the physical stock take, water leak has damaged to the paper and the glue. Accordingly, in the following week, ABC has spent approximately 15 rupees per pack for restoring and reapplying the glove. Yes, so it is restoring and reapplying the glove. That is 15 rupees. Calculate the net realizable value and the written down amount. Guys, if you look at, you find that the NRV of the glove today is only 40 rupees minus 15 rupees of repair. It is 40 rupees per pack on 15th of April minus 15 rupees of repair because there was some damage. That means the NRV of the particular product is only 25 rupees per pack. So, if you were earlier valuing it at 50 rupees per pack, today you are valuing it at 25 rupees per pack. That means the write down in the value of inventory is rupee 25 per pack of envelope. Here, NRV 25, inventory written down is also 25 rupees per pack. Estimated selling price minus estimated cost to sell. At the end of the financial year, Company P has 1000 units of inventory on hand recorded at a carrying amount of 10 rupees per unit. 100 units, 10 rupees per unit, total cost is 1000. Current market price is only 8 rupees at which these units can be sold. Therefore, the cost is only 8. The realizable value is only 8. You have to actually write down the value of inventory because your NRV is less than cost. However, Company P had a firm contract to sell to Company Q 60 units at 11 rupees per unit, which cannot be settled net basis. The incremental selling cost is 1 rupee per unit. The incremental selling cost is 1 rupee per unit. Therefore, determine what is the NRV of inventory P. Guys, if I look at the concept, I had 100 units of inventory, of which 1000 units, of which 60 units are expected to be sold under a firm commitment to a Company Q at 60 rupees per unit. Sorry, at 11 rupees per unit. Each per unit disposal cost is 1 rupee. So even that 8 rupees also current market price should be considered as 7 rupees as NRV. So if I am looking at solving this question, I'll go like this. Question number 65. How many units of inventory do I have? I have 100 units of inventory. Out of this 100 units of inventory, I'll divide it into two parts. Under a firm sale contract, I can sell 600 units, and without this contract, other inventory which cannot be sold as a part of this firm selling contract, 60 units, 60, and this will be 40. This 60 units, I have an NRV of 11 rupee is the estimated selling price, minus cost to sell 1 rupee, that is 10 rupees. While I am looking at the NRV of other inventory where there is no binding sale agreement, this inventory can be sold at 8 rupees. I'll incur 1 rupee as cost to sell. So my NRV is 7 rupees per unit. By applying this logic of NRV, I can say that the total cost is 60 into 10, that is rupees 600. In this case, 40 into 7, 80. If I combine both of them and try to come out with a single NRV, my total NRV is considered to be 880. Firm sale commitment for 60 units at 11 rupees per unit, and will I be incurring 1 rupee as cost to sell. The other inventory can be sold at 8 rupees by incurring 1 rupee as cost to sell. then the NRV is 7 rupees. So in total, the NRV of the total products of 100 units is 880 rupees. Look at the solution that he has given. Answer is 880 and that is absolutely right. Look at question number 66 then. Business has 4 items of inventory. Account of inventory has established that the amount of inventory currently held at cost are as follows. Estimated selling price, estimated selling cost. What is the value of closing inventory in your financial statements? A1 inventory, tell me, cost is 8,000. What is the estimate NRV? Estimated selling price minus estimated cost to sell 7,300. So which is lower? NRV is lower. So A1 should be measured at 7,300. A2 should be measured at 14,000 because their NRV is 17,800, much higher. B1, 16,000 cost, 16,800 NRV, valued at 16,000 itself. C1, cost of 6,000 and NRV of 7,350 should still be measured at NRV. So should still be measured at cost. So therefore, only A1 should be measured at its NRV. All A2, B1 and C1 should be measured at cost 14, 16 and 6. NRV of A1 is 7,300. Get the total 36,000 plus 7,300. 43,300 is your total cost of inventory or closing inventory. 43,300. Absolutely correct. Only A1 is measured at NRV. A2, B1 and C1 should be measured at cost. Look at question number 67. Finished good opening is 1,000. Raw material is 1,100. He again purchased 10,000 units of raw material paying 1 lakh. Labor 76,500. Overhead 75,000. And he sold 10,000 units at 2,80,000. At the end of the year, he again had a raw material of 900. Finished goods of 1,200. The expected production was 15,000 kg of finished goods. Guys, this is for absorbing your fixed overheads. Correct? 75,000 fixed overheads should be absorbed over expected production of 15,000 kgs. Overhead absorption rate is 5 rupees. Due to fall in market value of sale, the finished good was 20 rupees per kg and the replacement cost of raw material was 9.5 on the closing day. Calculate the closing inventory on that day. Guys, first look at this opening raw material, purchases, closing. Closing raw material. Tell me what is the finished goods produced during the year. Or I'll put it like this. Opening finished goods were 1,000. During the year you purchased 10,000. You are still left out with 1,200. Correct? So that means how much of finished goods have been produced during the year? Sales are 10,000. Correct? You sold 10,000 units. You opening already had 1,000 units. You are left out with 1,200 units. That means fundamentally you produced 10,200 units. You produced 10,200 units. I can solve it like this, 10,200. Please check. I'm starting with number of units produced, number of units of finished goods produced. Finished goods produced by the company, I can go on like this. If I take raw material as a basis in measuring it, then I will go like this. Opening stock, add all purchases that you have of raw material, reduce it with the amount of closing stock of raw material. The balance is produced during the year. How much is the values? Please check. 1,000, 10,000, 900. Sorry, 1,100, 10,000 and 900. 1,100, 10,000, 900, 10,200. Or else, even by taking the finished good also, you can get the similar answer. If I take finished good as a basis, then the amount of raw material finished good produced is equal to, I'll go like this, sales plus closing stock minus opening stock. This way also you can get. How many units sold? 10,000. What is the closing stock? 1,200. What is the opening stock? 1,000. How much did you produce? 10,200. So this is how I can determine the amount of material finished good produced during the year, either by using the raw material or by using the finished goods also. Either way, I can determine what is the value. Look back at the question. What is he saying? I have to absorb fixed overheads at 5 rupees per unit, which I have determined by saying 75,000 divided by 15,000. So if I go with the logic of calculating what is the cost, then you need to go like this. Your cost of production is, for raw material if I am talking about, it is 11,000 rupees of raw material opening, plus 1 lakh rupee of purchases during the year, plus 76,500 rupee of labor produced during the year. Fixed overheads absorbed on the basis of 15,000 kg is 5 rupees per unit, and currently you are producing 10,200 units. Therefore, absorb it at the rate of 10,200 into 5. That will be, I think it should come down to around 50,000, 51,000 I guess. So let's calculate like this. Let's see what is solved. Purchases 10,200 into 10 rupees. Labor 76,500. Fixed overheads 5 rupees into 10,200. Cost of production is 22,29,500. If your closing inventory is 10,200, then the cost per unit is 22,500. NRV already given to you is only 20 rupees. Therefore, since it is only 20, I will measure the closing inventory at NRV of 20 rupees. What about raw material? Raw material up above is already shown me at 10 rupees of cost. But there is a significant fall in the cost of raw material at 9.5 rupees on the closing day. So therefore, even the raw material should be valued at 9.5. So 1,200 units of finished good at 20 rupees, 900 units of raw material at 9.5 rupees. Both the cases NRV was less than cost. The total cost of the closing inventory is 32,550. Clear? This is the last question that we have. Please make sure that you answer this. Simple questions, guys. Inventory are not complicated. Cost of purchase 5 lakhs. Trade discount reduce 10,000. Use your calculator. 5 lakhs minus 10,000 trade discount. 4,90,000 I got. Import duties, I'll consider them as non-refundable. I'll add freight and insurance on purchases to be included 250 rupees into the cost. Other handling charges related to imports definitely added 100 rupees. Salaries to accounting department not included in your cost of inventory because it is administration cost. Broker commission paid to intending agents for arranging for imports. Guys, commission for arranging of imports is a marketing or selling expense. You cannot include this. Sales commission is also a selling expense. After sale warranty is also a selling expense. None of these get added. So it is 4,90,550. Okay, brokerage commission for intending of imports he added. So 4,90,850. All other expenses cannot be included in the cost, and that will bring us to the end of discussion on problems of IND AS 2. So that will bring us to the end of discussion on IND AS 2, guys. So we have finished this standard in comprehensive manner. We have looked at what is a discussion in the standard, also solved problems of illustrations, workbook, and your additions to study material. Beyond this, it is not necessary, because IND AS 2 is not some standard where you have identified questions in your exam on a regular basis. So you need not involve yourself too much into discussion on IND AS 2. Whatever we have discussed is more than sufficient. Put a full stop there. You don't have to discuss anything further on IND AS 2. Plenty of more problems are available if you look at your CA Inter or CWA Inter material, not necessary at CA final level. Clear? That will bring us to the end of the discussion on this standard. So we will now move on into the last standard relating to the assets, that is IND AS 116 leases. The discussion of leases I will carry forward it to the next session. But remember, 116 is probably one of the most important standard among assets, being the relatively a newest standard among all the assets, all the asset related standards that we have discussed. It was in the form of IND AS 17 earlier. Now it has taken the shape of IND AS 116. Thanks a lot for joining us this session. I'll see you again in the next session, beginning with the discussion on leases under IND AS 116.